Welcome to the Property and Coffee Podcast. I'm your host, Matt Atkinson.
I'm Matt Skehan.
We'll be fueling your financial future one coffee and property insights at a time.
Helping you navigate the property market like a pro.
Hello, and what a pleasure it is to have your company on the Property and Coffee Podcast today, where we're going to be fueling your financial future one coffee and property insight at a time. I'm your host, Matt Atkinson, and joined by my co-host, Matt Skehan. Good morning, Matty. You'll notice we don't have a guest with us for this session. Matt, we are just going to be having... That's it.
There's too much shininess from your head anyway, mate. So we'll put him in now. So.
I'm just embracing a new look. But look, we're just going to be diving into a bit of a review on the property markets. And as everyone would appreciate, look, we're living in an uncertain time again which to be fair is a new bit of global conflict. Recently, you think of recessions, pandemics, but it is obviously something that's now at the forefront of everyone's mind. And look, that does, whether we like it or not, factor through the property markets. And we might just take a pause, and why don't we jump in there, Matty? What are we seeing or hearing, and what's the sentiment just with this sort of global, what's going on in the global context? How's that impacting what we're hearing and seeing on the ground?
Yeah, so obviously as an advocate on the ground day to day, I think I say property is really simple. It's supply, demand and sentiment. So obviously nothing's really changed from a supply demand in the last couple of weeks, but sentiment's shifted, in my opinion, really heavily over the last couple of weeks. So, just got to pick up a paper. We were chatting about that before. Obviously, there's just a lot of negativity. There's a lot of fear out there. There's, I think people worrying about fuel and, sort of almost got memories of sort of COVID, there's like the 2020, which is still semi-recent. So I think, there's definitely been a shift. We've got a vendor advocacy client at the moment that's probably caught up in that. We've got, clients who are, spoke to a couple of prospects yesterday who want to upgrade because they're actually smart enough to realize that it's a great time to upgrade in a market where the more expensive homes can be cheaper, so they're going to trade up in uncertainty. But I think a lot of people are, like I use the Melbourne, the Property and Coffee podcast, but we love our cafes and people will line up for their croissant. I used to go into Cub in the city. They'll line up at Loon for 2 hours for their $12 croissant, and again, there might be a better croissant down the road, but it's social proof. So I think at the moment people are waiting for, proof and people are just fearful, right? We're talking about the papers. There's not a lot of good news stories at the moment. There's the war, there's petrol, there's rations, there's cost of living, rates going up. Everyone feels like they're just being punched, time and time again, I think, at the moment. So I think that's, I'm sure you're seeing a bit of that in your world. So.
No, that's true. And look, I think, if you're a newspaper reporter at the moment, the content pretty much writes itself. So it's a good time if that was your career choice. What we can do, though, look, we can't predict what is going to happen. What we can do, though, is fortunately we've got a lot of property data at our disposal. So what we're going to do today is we're going to do a bit of a deep dive into that and understand a bit more on the trends and what's happened in times gone by. And without any doubt, look, those periods have also been peppered with things like global conflicts, etc. So it'll give us a bit of a sense,
It's not new, right? Is it? You've been doing this for a while. There's always something. There's the pandemic. There's been recessions. There's always something. There's always news. And I think even this day and age with social media, we're more aware of what's happening. Than we probably. So again, I think people have this law of recency. They only think about and everyone's so busy. So, I think they just get tidbits and they it's like with land tax. People always, I get clients out of different states like, oh, land tax is horrific. But then you ask them, how much is land tax? And literally nobody knows. It's just because it's a clickbait. It's an article. It's attention grabbing, right? So right now it's like, petrol's gone off, but people are just, I think sensationalistic news sells, right? So fear sells. So I think right now we're in a, fear, but one of the quotes that I love is the Warren Buffett quote is be greedy when others are fearful and fearful when others are greedy. But a lot of people know it, but not many people actually have the courage to act. So I think now's an amazing time. So
good time to take up some opportunity. Before we dive into the data, why don't you give us just a little bit of an overview of the report that we're going to be looking at, just so we know what we're going to be diving into.
Yeah, so we're going to chat. So in our business, we're a property advisory firm, so data is very important. So we're going to chat through a white paper from HtAG Analytics. So it stands for higher than average growth. So very, scientific, research based, like looking at a lot of data points, cutting through the noise, right? Because otherwise, if you get your news from news.com or some of these other less, what's the right word? Herald Sun or whatever, like they're just clickbait. But we're obviously going to dive under that as well. This wouldn't get in the paper because it's not exciting. It's sort of a 20-page plus report and it's data, but
Yes.
it's that's why I wanted to just distill the key points for our audience. Hopefully they're a bit smarter than average and can use that for what they want. But it look at price growth, rental yields, cycles, and looks over the last sort of 1.5 decade as well. So some patterns and but they're very reputable and probably one of the larger research in residential property at the moment. So HtAG Analytics Whitepaper.
Perfect. Well, let's just dive right in there.
Yeah.
So we're going to run through. We'll put a link up to the reports if anyone wants to read the longer version. But what we're going to do is we're going to cherry pick a few of the themes there and just unpack them a little bit more. And as you pointed out, Manny, look, it's a very comprehensive report, some really good data, and it does look across the country.
Yeah, so it's holistic, and I think that's really important because even these days, like a lot of our clients, investors, I'm sure you're the same, that they're not just looking at Victoria or New South Wales or Queensland. They're looking at it holistically, and it's like, okay, if I want equity in the next 2 or 3 years, where am I going to get that return? Because obviously you need equity for the fund to deposit for the next one. So, I think that's, people want returns. They don't want their money doing nothing for years on end. So market cycle timing is quite important. So,
well, there you go. So the first one we're gonna touch up is it's around looking at we call it the Great State Divergence. So, and a bit of talking about rental yields, and in essence the yield trap. So this one we're focusing a bit on specifically WA or Western Australia. So what the data shows is that we've had a massive convergence where, as an example, Western Australia, we've had the prices move from, your average median price gone from $400,000 to over $850,000 in a space of just 5 years.
I think people don't realise that's how big that is, right? So for 13 years before this boom, it did nothing, tracked sideways. So again, people have a recency bias, but like 400 to 850, that's huge in 5 years, right? So that's a big numbers, yeah.
I mean, that's essentially doubling.
In 5 years,
Call of rule of thumb, most people go, if it doubles every 10 years, you sort of, you're tracking well.
Yep.
If you kind of apply that and you go, well, actually what they've done is they've done it in half the time. That is a huge amount of growth.
Correct.
Which is, you can see why people have been, you understand why people have been piling in there. And obviously there's some people that got in there on the front foot prior to this growth really taking off. That would be,
they'd be very happy.
Be pretty happy with how things have
rental yields, and they'd be sitting on some good equity. They're probably looking to go again. So yeah.
That's true. We can see Western Australia, Queensland, and South Australia. They've had phenomenal growth.
Correct.
Whereas our place of Victoria has stayed relatively flat.
I've been in the doldrums thanks to Dan the man.
How do we see Victoria compared to these other states?
I was saying before, no offense to Adelaide, but Adelaide is more expensive than Melbourne at the moment, which is that's really unusual. And Adelaide's obviously the 20-minute city, the city of churches. It doesn't have the economic might or the knowledge city of a Melbourne, which is a true international city. So I think Adelaide's doing great. They've got some probably more progressive government, but Victoria over the last 5 years has really done nothing, really. So I think that's probably the opportunity as we distilled this report. It's obviously looking at the contrarian cycle timing. So people obviously talk about these most recent runs in those states, but Brisbane's had floods and it had a long period of not much growth. Perth before this 5-year boom had 13 years of sideways or reverse growth, and SA has probably been not. It's obviously done really well with a lot of defence stuff and getting quite I think it's doing quite well from events and other things and a whatnot perspective as well. But basically Victoria's sort of underperformed and that's almost the opportunity. So because even these other states have performed better because before that they underperformed. So there's a
just different cycles. Hard.
You just don't want to chase this, and you don't just chase gains, right? If you're chasing gains, and if you're buying in Perth today, that's in my opinion very risky. And I spoke to someone actually, I think, the Wake who's got a place that hasn't been settled yet. So off the plan in Perth, and that's fraught with danger, right? Because if you're buying peak of the cycle, house and land in a greenfield area, that you could be sitting on that for a decade and not seeing any gains and fundamentally an average
That's
asset
true.
too. So.
You also don't want to be trapped in a negative equity scenario, but we'll touch more on that a bit later. Moving on, so we're going to shift our focus in more to understanding, just looking at rents and rental growth and what's been happening there. So essentially, on the back of COVID, we had really good rental growth.
Yeah, we had phenomenal rental growth
across the country.
Yep.
Whereas what we're seeing now, that growth has now stabilized,
Yep.
where there might be slight movements, but typically we've sort of got to a point where growth has come down as to what we would expect. What does this mean? If we look at how an investor would have invested maybe 3 years ago in some of these areas, how would that impact the same person?
Yeah, I think if you're an investor, you obviously, I think property investing, you should be a growth focus because obviously the entry and exit costs are high, but yield or cash flow keeps you in the game. So I think a lead indicator is that cash flow, and some of those markets like in a Brisbane or an SA or a WA, those yields are coming back, so that those markets are less attractive. And in that same report, what we are noticing is that in Victoria, those yields are probably bucking the trend, and they're showing the early signs of the market shifting. And we noticed that last year in the marketplace, but obviously this year we've had some rate rises, sentiment's really shifted. So I think the fundamentals are there because the supply demand equilibrium is really out of whack in a big city with all the people and the jobs and the here as well. So, but yeah, yields are really important because obviously they're a bit of an indicator of where you should go. Because if the yields are above average, it's probably showing there's some growth there. They're inverse, so they don't often grow at the same time. A lot of people think they do, but there's a growth and the rental yield. There's sort of there's a correlation. But yeah, so I think a lot of markets where there's some the cash flow diminishes, people look for better returns elsewhere. So
that's it. As the market gets more mature, whether that be for housing, people setting that up, communities, typically you might see that sort of go down south a bit more.
So Maddie, getting back to the finance side, as I say all the time, property is a game of finance. So obviously, with some of the states in New South Wales and Vic, the sort of headline gross yield number, which I think is again just the headline numbers in the sort of high twos, which is not great. Obviously, are you seeing that affect people's borrowing capacity and ability to invest these days? Because obviously that's a significant negative cash flow if you are going to buy a property. Just so you know, we're not buying properties in the high twos yields, but obviously some people might have some deeper pockets than our clients, or just like to throw money away. But how's that affecting the finance side of things on your side?
Yes, look, good points. I might sort of hone in on two issues here. One being we'll look at a low rental yield in this case, and we'll touch on the interest rates, which is obviously something sitting in the back of people's minds. When we are applying if someone's looking to take debt out to buy an investment property, part of that you can include the rental income to increase what you could potentially borrow if you had no rental income, as an example. If you're buying a property with maybe below average rental yield, it just means you've got less income to support the debt that you need. This might be fine because your personal incomes, whether that's through business or through your permanent employment, might be sufficient to get you there. On the other hand, with rates rising, that also impacts your cost of debts becoming more expensive. When banks look at you, typically they will stress test it and add on a buffer. All that happens now with the rates going up, that buffer will also look to increase.
So with the banks, obviously they're putting a buffer on the interest rate, but they're also putting like is it 75 or 80% of rental income they use, or what's the latest?
Typically they shade it. So again, depending on lenders and policy.
What does shading mean just for the average average?
So let's say you could include you get $100 in rental income. Banks will look at it and they'll take a risk assessment and say, look, we may only let you include 75 or 80 as an example.
Factoring in a vacancy or
they're
whatever.
just de-risking to make sure.
The banks are conservative, right? They only care about themselves. So,
so that's what they're doing to make sure, look, if there's as you said, you've got a vacancy or rates change, you've got sufficient funds available, you're earning sufficiently to still meet those repayments.
Yep. Cool.
So that is something to bear in mind. We run those scenarios with our clients before they go out so they can understand, say, look, we can afford this debt, but we're quite clear on the yield they should be thinking about. And look, that might be a factor that changes once they find a property, but they do need to keep that in mind when they are looking. Yield's not everything, right? In the sense of
everyone's got a different strategy, right? I think, and that's
it. But you do need to, if you're looking to get debt, you do need to consider that as part of understanding what you can afford.
Correct.
Switching tack now to a different topic, we're going to look at the Victorian market and the recovery, and also just dial into potentially some suburbs where there might be some growth opportunities. So Victoria's in this when we look at this study, when we look back from essentially it covers Feb 26 back down to Jan 2010. So it's a good amount of time. But Victoria is the only state where yields have essentially increased relative to other states over that period. And it comes back to that, why is the market overlooking Victoria when we keep this in mind?
I can tell you why.
And is it the best risk-adjusted place to purchase your next property at the moment?
Yeah, no, good question. And obviously I've got a bit of a bias given I'm a buyer's agent focusing on Victoria. But if you do look at the numbers and the data, we can share the report. If you want to reach out, we'll send it to you. The numbers don't lie, right? Like there's a heavy focus on Victoria. So I've said it earlier, but supply, demand and sentiment drive the market. Victoria's had some real headwinds from Dan, from COVID, from the land tax, from the rental compliance. And a lot of people not educated about what those factors are. And a lot of people are going to be investing in affordable markets. Land tax isn't that big of an issue. And let's be honest, I've got properties in investment properties personally in other states. Most of them are following rental compliances. They're sheep. Politicians, they see some way to it just follows around, right? So I think we've been hammered by that, like sentiment, like it's like in Brisbane when they've had floods historically, like that really affects the market, big floods up there. And there was there's these big events really, they affect the mind.
Take the toll.
There's so many drivers in Melbourne. It's an international city. Like getting inquiries from various places. It's the education, it's the lifestyle as well. So, but the data's don't listen to me. The data's pretty strong and and compelling. As I said, if you're actually a data based or basing it on the numbers are showing you that there's some opportunity. And like I say to people all the time, one of my worst questions I get asked is, how's the market? Which market? There's obviously there's so many different markets, but obviously that's in the skill of someone like us to pick them apart. But
do the research as well. It takes time.
100%. And I think there's even that's why the data in Melbourne and at a headline level I think is always hard as well. Sydney, because there's so big markets.
Yeah.
There's always markets. There's almost always ways to make money in my opinion. You've just got to find the value and see the opportunity where others don't. And if you're a bit contrarian, that's probably where you make the most money. But you've sort of got to be a bit keen to be an early adopter, which not many, most people like to follow the lead, follow the herd. It's safer in the pack. So it's interesting time. So,
and if you go back to those three, I want to see three key things we spoke about before, which is ultimately, and obviously probably applicable more, I want to say more to Victoria, but definitely prevalent here is, you got a housing supply problem.
I think we're 200,000 houses behind the target, so we're never going to build enough. Like the government can't build anything, on budget or on time, and no offense to the government, but that's just fact.
Is, if you said it in its own right, great. If we catch that, but we're
not going to.
We bring in people want to move here. They want to live.
We don't even have enough trades to build.
They want to live in Victoria.
You talk to people who go to trade schools, and there's no one. Everyone's AI revolution, but like we don't even have any trades. So plumbers, electricians, they'll probably earn more than lawyers.
And on that point, with everything that's going on globally, you wouldn't be surprised to see construction costs go up. So you got which if you got an existing property, that's probably not a bad thing. Around it's costing more to build new.
It already has, right? And I think people are fearful of that because obviously, COVID, we saw like 40 to 50% spike in costs, and so I think it's not going to get cheaper. There's so much red tape and to go through planning and whatnot as well. So it isn't going to get cheaper. So it never does, right? Costs never tend to go backwards, right?
No.
Once your coffee gets to a certain price, it doesn't tend to go backwards, yeah?
It stabilizes for a bit.
Yeah, correct.
Okay. Moving on to our next topic is we're going to call it the fastest horse strategy. So the white paper touches on a number of suburbs. 61% of them are actually in Victoria, where they've previously underperformed, but really now we're seeing some short-term growth in a positive direction. How would you analyze these suburbs where it's looking good at the moment, but obviously you need to dig into them? How would you go about looking at suburbs as an example, like Ivanhoe?
Yeah, so Ivanhoe's like, even that report, like Ivanhoe's probably out of reach of most investors, but I was in an area yesterday, I was in Blackburn Central, which is sort of around Blackburn North, Mitcham, sort of not far from Ringwood and stuff. So I think all those suburbs in that corridor, even Blackburn South, are in that report as well. So even Blackburn Central, like that's a new shopping centre last couple of years and banging, and You know, as I said, you're next to some more expensive suburbs. You know, some affluent suburbs. You've got sort of gentrification drivers. You've got cafes changing. You've got good schools and good infrastructure. So I think for me as a buyer's agent, I think a lot of people say they're data driven, but data's only part of the job, right? Because I think investors get it wrong when they forget that 70% of the market buys with their heart. That means they're a home buyer. And obviously emotion, schooling, status, they matter. You know, people don't want to say they live in the arse end of a suburb or whatever. So you need amenity and lifestyle. So I think the data's good at start, but obviously you've got to, you know, either pound the pavement or get someone like us to help just to correlate those gentrification drivers, which is the cars, the cafes, the renos, the schools, like what's actually going to, you know, want people to live there.
Yeah, what's the substance?
Yeah, what's the aspiration? You know, because I think even with all these changes in taxes and stuff, and we caught up with some financial advisors on Friday, just gone for lunch, and I think like the family home is probably going to become even more important for wealth creation because unless the government's silly, they're probably not going to tax a family home. They're taxing everything else, right? But the family home is I think, a really important wealth creation vehicle, and investment properties might become a bit, you know, there might be as many bigger portfolios, it might be commercial, business ownership, but I think the family home's important because that's CGT free for the foreseeable, and I think people put their money into that as well, which we love property in, and that makes sense. So
it's a good point. Just want to highlight one thing you sort of mentioned there. You think of, you know, let's say these reforms come through and it impedes investors.
Yep.
You always wonder if something like that was put forward, how do they look at, you know, meeting the housing supply crisis?
I don't think they do.
You're not making
they do.
You're not making it easier for people to maybe build houses or. Anyways, we'll unpack that when we get some more news on that. But again, it is an interesting.
I think it's a perfect storm if you're an investor, right? Like
people
if and everyone's got a different phase. I think if people have been in the system for a long time, you know this with clients who are used to something, they don't like paying a new tax that they've never paid. But if you're younger and you're trying to get ahead, and people talk about Gen Z and housing affordability, but I think there's some good opportunities out there because there will be, unfortunately, a almighty rental crisis in the future. Like vacancy rates we were looking at, say, some suburbs yesterday, like around Frankston, like your sub 1% have been historically for a long time. That's not a healthy market. You should be 2 to 3 vacancy rate. And that's now. And it is more sell-offs and less investors buying. So in 2, 3, 4, 5 years, with migration being whatever we are, 350, 400,000 people, where are they going to live? We don't build the stuff people want to live in. So I think, you know, renting will be really tough. And obviously it's not good for people who need to rent. It's good for an investor, but like that's going to put pressure on it, and it's going to then make the numbers more attractive. I think next 5 years will be interesting, right? So, but opportunity with change is, you know, just understanding the data and I suppose just backing yourself with the right choice. So.
That's it. Keep on top of it and make the adjustments as required.
Okay, so Maddie, again, we've talked a bit about finance, and I said property is a game of finance, but in a transitioning market like Victoria, I think a lot of people still don't understand like a valuation lag or even how the valuation process works. I think it'd be a good time to explain a little bit about that, because sometimes people get shocks about valuations and they might not get a number they like, but how does, you know, simplistically, how does the valuation process work for your clients?
Sure. So typically where people might intersect on a valuation or where it comes to the fore, they've bought a property, and what we need to do is do a valuation to make sure it stacks up and the bank's happy to take that as security. The second might be if we're looking at doing, let's call it a refinance, where we can go and order valuation. So that's typically where people might intersect with them. Banks typically, there's sort of two ways valuation will generally be conducted. So the one way is might be a desktop valuation. They'll look at past darts in the area, what sales have gone through.
It's only between 3 to 5 settled sales quite recently, isn't it? Normally,
they'll also try look and understand what your house condition is relative and find a bit of a middle ground. Look, banks have some nuances between lenders on how they then might look at that within the valuation space and the metric. The other way is what we call as a short form valuation, or that's where someone would physically come and inspect the property.
How many people are physically getting out now? Because I know COVID's changed it, but how many physical valuations are you seeing?
Well, it just depends. So for example, maybe you don't have the enough data there for them to make an accurate read, or you've done things like renovations, you've changed the house. You want to have someone to come and have a look and understand what that looks like and make sure then you're getting an accurate view. So that's how the banks, that's how the valuations for someone, that maybe doesn't know a huge amount about them. That's how typically they would be conducted. What we're referring to here when we say the bank valuation may come in soft. So what may happen is we're looking at past data when we're doing a desktop valuation as an example. So what they might be looking at is past sales transactions that have occurred within a period of time. And then they'll be selecting some of those to benchmark. So what that means is if sales for comparable housing within your postcode or sort of an area that's comparable has come off a bit soft, that might be what is determines the value of your house. What's important here for us, and this is from an investor side of thing, is where you might find that properties may be undervalued. If someone is relying on purely on the bank's valuation,
they're not very good.
To determine the sales
conservative. They've obviously got their own risk profile as well. So like it's often
that's it.
Bit of bias as well to what they're doing.
And this is why it's so fundamentally important where, if you are selling, if you've got an expert in that field, likewise if you're buying, because you might go, great, the bank's valued at X, the market's changed in these since, on the comparable sales.
Totality, and there's an AVM, which is a computer generated algorithm, and it's almost never accurate. Like it's a guide, but like
totality is hugely property, especially in the broker space.
Yeah, but there's always a margin for error. There's always nuances, and so it's a guide, but like it's there's so many other factors and stuff, and this is, as you know, there's outlying results as well and stuff. So you sort of need a little bit of valuation. I used to work with an ex-valuer at my work, and it's part art and part science. It's not fully, because property is that
there's
way,
a bit
right?
of grey there.
Yeah.
But that's it. So to bring that back, it's a good place to start and get a benchmark depending on what you're using it for. But if you're going to go through a process, as an example, where you're looking to buy, looking to sell, you want to use that as a call it a starting point, but you also want to make sure you confirm that up. You might be knowledgeable as an investor, or if you don't know the area too well, speak to someone that does. Because that's where you might have an opportunity and go, look, so-and-so is selling their house for X, but we know it's potentially going to be, it's a recovery suburb. Values might be changing over a short space of time.
No, that's good tips. And I think the key is just get a good broker, because obviously they can shop it around. There's different lenders, there's different appetites. The valuations can vary heavily. So don't just get one opinion, get someone who can hustle for you and work for you, right, as the client. I think that's key.
And values also, different firms do specialize in different areas.
Correct. Yeah.
And probably more going into the commercial side of things, but you want to make sure the people that are looking at your property
are
the right people. Okay. The last segment that we're going to be discussing today is around risk management and potential no-go zones from a suburb perspective. So the first one is we're going to just touch on. So in the report, there was 141 suburbs flagged as, want to call it, overheated from a
overcooked, mate. Stick a fork in them. They're almost done.
87% in Queensland and Western Australia.
Makes sense though. Massive growth. Like that's it's not sustainable, right? Like even with affordability and this, people can't keep borrowing. At some point there's a cap. Yeah.
That's it. Well, we look at, if we pull out one suburb from the masses, Ripley up in Queensland, that's had 1 year of growth of 38.5%.
I don't know Ripley too well, mate, but that's almost 40% growth in 1 year is phenomenal, mate. That is huge, right?
That's almost winning the lotto type of numbers. But what does that mean? So it's all good and well that suburbs grown really well, and there might be some really good underlying factors that support that. But does that mean potentially there's going to be a pullback that might be inevitable?
Pretty much always is. I said, look at value of general data over the last 40 years, like a suburb, like hotspotting, I don't love, because I think that's very short term. Yes, it's important if you're trying to build a portfolio and be aggressive, but when you average something out over 10, 20, longer period, things revert back to, because if one suburb performs at 40%, everyone's going to go, that's too expensive. What's the next bridesmaid or Ripple suburb? So there's a correlation, So I think, like short term, you can get those performances because obviously it could be a resource area. I don't know, Ripley. I don't know Ripley very well, to be honest. Or it could be it's got a contract or whatever it is. There could be a scarcity of supply or something. But ultimately, you still have the fundamentals. But as I said, over time, and if you look at the data over time, the longer the time period, you don't see those outliers because they average out. Because at some point, someone's going to go, that's just stupid to pay that much money there. I'm just going to cross the road, change a postcode, and not buy there. And that's the ripple effect we call the bridesmaid effect. So gentrification. So
good thing to be aware of, not necessarily, as you said, to be caught up in the headline numbers and someone saying, well,
people do though. People follow those and, and they
unpack the data.
And that's how people make their money. They cash out and someone comes in late. So unfortunately, for the wealth's the transfer from the patient to the impatient. So there's always someone who's trying to make money and gets in a bit late. So Maddie, last one for today. So like for some of the people listening who have sat on some massive equity in some of these markets that have peaked, something like the NT, which is, again, and showing it's at its peak, like, is there any advice you'd give whether they should be refinancing or selling? I know it's obviously a holistic approach, but given you're sort of in that space a little bit, you got any clients that you're chatting to or sort of advice for people who are, potentially more, I suppose, more speculative markets that historically have more, higher highs, lower lows? Like what's your 2 cents to those people at the moment who might be weighing up the options?
It's great to see if people have invested and they've made equy and
taken action, mate. Action is number one, right? Do something.
So look, what we also got to keep in mind is if we're refinancing, we want to make sure income and servicing stacks up.
Yep.
And then it becomes an equity question. So typically banks aren't going to let you, or you don't want to get into a lender mortgage insurance territory and pay and leverage more than 80% of your house when you're doing, especially in a refinance.
No one wants to give the bank more money, mate. Not as a rule.
But banks do look at these different postal codes, especially in the regionals, and they might, from their own perspective, not lend you as much or have a cap on how much they will lend.
Is there any postcodes or areas that you're seeing as flagged as high risk at the moment?
Well, what we're seeing as we get, if I want to call it, you might look at it from a population density perspective.
Yep.
So what you might find is in a metro location like Melbourne, in your suburbs, banks happy to lend up to 80% on a property. Where we get potentially more regional populations aren't as high or might be invaried or exposed to other risks, they might say, we'll still lend money, but you're going to have to tip in more from an equity perspective. So we might only lend you 60%.
I think that's important for listeners because obviously property is a game of finance. If you've got less ability to resell and your market's investors, like that's when you get sometimes caught when the tide goes out type thing. You might have these big gains, but then you can easily go back down and you actually can't get out on the way out because you've got no one who can come in because they don't have the deposits or the equity. So that's important to know, So. Well,
that's it. So in some of these areas, and I know we're focusing maybe on a place where you might be at risk around a bit of a pullback, but you don't want to be caught in a scenario where you've refinanced up to 80% or whatever the max might be. Property's taking a turn. You're almost stuck with negative equity,
and you're stuck. And then you've got your hands are tied, right? You can't do anything.
And typically, you would know. Your buyer pool, especially if sentiment has dropped in that space, you might say, I'm going to take a loss and exit.
Some of you can't. Like in some of these perf areas, like in my old work, we're a bit selective when we're going there because some of these days on market were 12 months. People don't realize that. We're not talking 12 weeks. Like Melbourne's, 4 weeks, like 6 weeks is a long time. 12 months. So you've got to be careful. I think you do your own research, right? Real estate's caveat emptor or buy beware, but I think a lot of people just love the headline numbers, So.
Well, that's it. So you need to be careful. And look, different people might say, I'm happy to sit on this long term and that's not a problem. Someone else might be, they might have a different plan where they're wanting to sell and gear up. So
the crypto fans, mate, they might be trying to ride the crypto wave. So
well, there you go, mate. So you do need to factor that into your plans, and saying that obviously goes without saying there's great investment opportunities, but you do need to understand what that data looks like. Also go back in time, as you say, because a lot of these places which are booming now, they flatline for a number of years.
Yeah.
So you do need to consider that in the greater scheme of things around the cycle. And maybe just to finish off there, Matt, we are seeing, from the growth rates really sort of peaking, stabilizing, some dropping off. If we do have an investor where they've bought well into a regional mining town that's seen 20, 30% growth over a very short space of time, what should they be thinking about, especially if there's a bit of a pullback potentially on the horizon, in terms of what they would do with that property?
Yeah, it's a really good question. And as a rule, I don't specialize too much in sort of mining or speculative towns, but my 2 cents would be, firstly, you've got to understand the fundamentals of supply and demand. So it's probably important chatting to a property manager and a good sales agent, getting your team around you, because obviously you've got to understand those indicators and just to see if it's sustainable. Why is that? Because obviously some of it's heavily on a contract or it's a short-term supply issue. So hopefully you've done that research before you got into that market. Would be my 2 cents. You've got to understand the cycles, right? Because it's speculative. So property, I think, it's in my opinion, is a get rich slow scheme. It's
Yes.
not a get rich quick. So I don't quite believe in that. I think there's other ways you can, even with renovations now, some value add stuff that you get a bit more creative, that are probably a bit low risk. But yeah, so for me, I'm not an expert in that space, but you obviously got to understand that area before you get into it. It's like even share investing, understand the business, the P&L or the balance sheet or the fundamentals, the vision, I think that's the key, because obviously, it's hard though, because no one rings the bell at the bottom or the top. So it's speculation. Sorry. So I think you just got to obviously have the risk appetite. You should have to be hopefully a more sophisticated investor. So hopefully that's less of your portfolio, and you don't want your whole super and relying on it, in my opinion, because it's riskier. So.
Oh, that's true. Thank you. That's all we're going to have time for today. We hope you enjoyed the breakdown and a bit of a look into some of the data driving the Australian housing market.
Thanks, Matty. Thanks, guys.
If you would like to keep receiving property insights and golden nuggets from our guests, please do follow us, and you'll get the latest episode released on a fortnightly basis.